Welcome back to today's deep dive. We're looking at something today that I think everyone, especially traders, can relate to. It's this universal problem where most traders actually know exactly what they're willing to risk.
Right. Their logical brain is, fully online. They've got their entry points charted out.
Yeah, exactly. They know their profit targets. They've set these hard stops for when a position goes against them. But then, the second the market opens and those bid-ask spreads start flashing, it all just falls apart.
It really does. A position starts bleeding, and these incredibly smart people just completely self-sabotage.
Right. And today we're pulling from a really fascinating source. It's called The Discipline of Profit, Mastering Trading Psychology and Systems.
Huh.
We want to figure out why this happens, and more importantly, how you can actually stop doing it.
Yeah, it's kind of the ultimate human dilemma applied to capital markets, right? You can build the most robust, back-tested algorithmic framework in the world.
But the moment real liquidity is on the line.
Exactly. The moment real money is involved, that carefully constructed plan is just routinely thrown out the window. The source text points out this really inherent contradiction.
Which is what, exactly?
Well, we demand rules to manage our risk, right, to create some sort of consistency. But our biology actively fights those rules the second we experience financial stress.
Okay, let's unpack this, because to understand why we break our own rules, we first have to look at, the environment where those rules are made versus where they're actually tested.
There are two completely different worlds. Totally different.
Right.
The author really emphasizes that a trading plan is almost always drafted in this vacuum of calm. You're sitting at your desk on a Sunday afternoon.
Right, with a cup of coffee, totally relaxed.
Exactly. The markets are closed, the charts are totally static, and you're just plotting your strategy. You're acting as a perfectly rational actor.
But then Tuesday morning hits.
Tuesday morning hits, the opening bell rings, and those level 2 order books are moving at lightning speed. Volatility spikes, and your brain chemistry fundamentally alters.
Yeah. The text actually mentions some specific research on this from the University of Toronto's Rotman School of Management. And the findings are honestly pretty wild.
Oh, yeah, they are.
It's not just that people get nervous, right? Their actual physical state changes based on the news cycle or the mood of the market.
Yeah.
And that physical state dictates their financial decisions.
What's fascinating here is the underlying biological mechanism. The researchers at Rotman looked at how environmental stress, like a sudden drop in the broader market, or even just reading a highly alarming news headline, it triggers an actual physiological response.
Like a fight or flight kind of thing.
Exactly. Cortisol just floods your system. And when that happens, your brain biologically shifts power away from the prefrontal cortex.
That's the logical part, right?
Right. That's the planning analytical center of your brain. Instead, the steering wheel is basically handed over to the amygdala, which is your primal fight or flight center.
Wow.
Yeah, you literally lose access to the part of your brain that wrote the rules on that calm Sunday afternoon.
Wait, so you're basically trying to execute a complex, highly rational financial strategy using the part of your brain that's designed to run away from a bear.
That is the literal biological reality. The same investor will look at the exact same technical setup entirely differently if their cortisol levels are spiked.
Just because of a prior loss or some sudden market volatility.
Right. The logic hasn't changed at all, but the organism interpreting the data is in a state of survival, not calculation.
Taking the biology into account, it really makes me think of grocery shopping on an empty stomach.
Oh, that's a great comparison.
Right, because you sit at your kitchen table, which is your calm environment.
Yeah.
Your prefrontal cortex is totally in charge, and you write out this very rational grocery list.
Chicken breast, brown rice.
Yeah, exactly. Chicken breast, brown rice, broccoli. You have a budget. You have nutritional goals.
Yeah.
But then you go to the store and you're just starving.
And your blood sugar is low.
Your blood sugar is low. The environment is super overwhelming with all the lights and people. And you walk down the baking aisle.
Oh, no.
The smell of fresh bread hits you. And suddenly that rational list on your phone means absolutely nothing. The stress of the hunger just completely overrides the plan. And you load your cart with junk food.
Yeah, the environment you're executing in completely hijacked the environment where you made the rules. And in trading, that junk food is, well, it's an emotional decision that deviates from your predetermined risk parameters.
And the source text is very clear that these deviations, they don't just happen at random, right?
Not at all. Our amygdala gets triggered by highly specific, highly predictable market conditions.
Yeah, the text outlines 4 specific triggers, which honestly feel like the 4 horsemen of rule breaking.
They really do.
The first one is probably the most notorious, which is losing trades. Holding on to a bleeding position way longer than the original plan dictated,
Yep.
just desperately hoping for a bounce.
And the mechanism behind this is the psychological weight of unrealized versus realized loss.
What do you mean by that?
Well, when a stock breaks through your predetermined stop loss, closing the position requires you to execute an action that locks in a financial loss, right?
Yeah, you have to click the button and take the hit.
Exactly. It forces you to formally admit to yourself that your thesis was wrong. But as long as the position stays open, the loss just feels, theoretical to your ego.
So the trader thinks, oh, if it just bounces back to the VWAP, I can get out at break even.
Precisely.
Which is exactly how a strict, 2% risk limit suddenly turns into a 10% portfolio drawdown.
Yep, you're just watching it fall, totally paralyzed.
And that freeze response,
Mhm.
it doesn't just happen when you're deeply in the red either. Which brings us to the next trigger. The text mentions trades that stall or reverse. It doesn't even have to be a catastrophic drop. Sometimes it's just the uncertainty of a trade going absolutely nowhere.
It's the decay of conviction. I mean, a trader might buy a breakout expecting this huge momentum, but instead the asset just consolidates.
Right, it just trades sideways in this really tight range for days.
Yeah, it hasn't hit the profit target, but it hasn't hit the stop loss either. And according to the text, this kind of stagnation breeds a really unique type of emotional reaction.
Boredom, right.
Boredom, exactly. Or they start second-guessing their initial assumptions simply because the market isn't rewarding them immediately.
So they start looking for reasons to just exit the trade early.
Right, they abandon the thesis entirely, just to free up the capital and relieve that sort of low-grade anxiety of waiting around.
And then on the complete opposite end of the spectrum, you have the third trigger, which is fast-moving markets.
Oh man, pure unadulterated FOMO.
Yeah, the fear of missing out. Let's say a surprise earnings report drops, or the Fed makes an unexpected announcement.
The algorithms kick in, the chart just goes parabolic, and the careful plan goes straight out the window.
Because the physiological urge to chase momentum is just incredibly powerful, isn't it?
It's overwhelming. The trader sees a stock surging, and the fear of missing out on a massive, easy gain completely overrides their parameters for entry.
They don't wait for a pullback.
No. They don't check the risk-reward ratio at all. They just hit market buy because the pain of sitting on the sidelines while everyone else is, ostensibly making money, it feels worse than the risk of buying the top.
Wait, hold on. Okay, losing trades causing panic makes total sense to me. Getting bored out of a stalling trade or chasing a parabolic spike, I completely get the biological drive there.
Right?
But I really have to push back on the second trigger of the source lists. It says winning streaks are a major trigger for rule breaking.
It does say that, yeah.
That feels completely counterintuitive to me. If my system is generating a massive winning streak, shouldn't that, validate my rules? Shouldn't success make me more disciplined and reinforce the good behavior?
Logically, yes, it absolutely should. But remember, we are analyzing human psychology under the influence of changing brain chemistry.
Okay, fair.
When a trader hits a string of, say, 4 or 5 highly profitable trades in a row, a massive dose of dopamine floods their system.
Oh, I see.
Yeah, the mindset shifts from calculated risk management to this feeling of total invincibility. The text explicitly warns about this, calling it the house money effect.
Because they start attributing the success to their own genius rather than, the statistical edge of their system.
They absolutely do. And that overconfidence leads to immediate rule breaking. A trader on a hot streak will suddenly start sizing up their positions well beyond their normal risk parameter.
Just swinging for the fences.
Right. They'll take suboptimal setups because they feel like they have the magic touch. The source actually highlights how traders begin to form an emotional attachment to the assets that made them money.
Oh, they fall in love with the stock.
Exactly. And the author offers a brutally strict rule regarding this. They say, you can love your spouse, but don't love the stock.
That's good.
Because the market doesn't know you own it, and the market doesn't care. The moment you start feeling affection or loyalty toward an asset because of past performance, your judgment is completely compromised.
Don't love the stock.
Yeah.
It's such a simple phrase, but man, it is incredibly difficult to actually practice.
Oh, definitely.
So if we know the environment is hostile to our prefrontal cortex, right? And we know these 4 triggers, the bleeding loss, the stalling trade, the FOMO spike, and the dopamine-fueled winning streak, they're all just waiting to trip us up.
Yeah.
How do we actually bridge the gap? Because a trader doesn't just consciously decide to destroy their portfolio on a random Tuesday.
No, the destruction is almost always incremental. The text points out that traders don't abandon their rules in one sweeping gesture.
Because that would cause too much cognitive dissonance, right?
Exactly. Instead, they justify the betrayal through these tiny little compromises they negotiate with themselves.
Here's where it gets really interesting. Because the text uses the example of a trader moving their stop loss down just a few cents to give a trade, quote, room to breathe.
Yeah, we've all been there.
Reading that part, the psychology suddenly clicked for me. It is exactly like hitting the snooze button on your alarm clock.
Oh, that analogy tracks perfectly with the concept of incremental compromise.
Right. Think about the mechanics of the snooze button. The night before, when you're in your calm environment, you set the alarm for 6:00 a.m.
You're being rational.
You logically calculate that you need that time to work out, shower, and commute. That 6:00 a.m. alarm is your hard stop loss.
Yep.
But then the morning comes, the alarm blares, it's freezing outside the covers, and your biology just wants to stay asleep.
It's survival mode.
Exactly.
Yeah.
You don't decide to skip work entirely because that would be too jarring. Instead, you tell yourself a small lie. I just need 5 more minutes.
Right.
You hit snooze. You literally just moved your stop loss down.
You've altered the risk-reward ratio of your entire morning based purely on the discomfort of the present moment.
And what happens 5 minutes later? The alarm goes off again. And getting up is actually harder now because you're in this fragmented sleep.
So you hit it again.
You hit it again. Another 10 minutes, you make another small exception. Suddenly at 7:15 a.m., you're sprinting out the door, your stress levels are through the roof, and your entire day is derailed.
You're infinitely worse off.
Way worse off than if you had just accepted the initial pain of waking up at 6 a.m. Moving a stop loss is basically hitting the financial snooze button.
It really is.
You're just delaying the pain of being wrong, but you're multiplying the eventual damage to your capital.
Because the psychology of loss avoidance is just relentless. By hitting that financial snooze button, the trader avoids the immediate ego blow of a realized loss. But the text provides a pretty stark reality check from a professional standpoint. The author writes, and I quote, "Don't feel bad about taking losses. If I can make one thing clear, small losses are always preferable. Always, always, always. Professionals like me take losses all the time."
The repetition of always, always, always really drives home how non-negotiable this has to be.
Yeah, because the author understands that ignoring a stop loss once doesn't just hurt that single trade, it fundamentally rewires your habit loop.
Oh, wow. How so?
Well, if you break the rule and the stock happens to bounce back, you have now positively reinforced terrible behavior.
You got rewarded for being undisciplined.
Exactly. You've taught your brain that rules are optional, so the next time a trade goes against you, moving the stop loss won't even feel like a compromise anymore.
It'll just feel like standard operating procedure.
Right. And eventually, you end up holding this massive bag, tying up your capital, and dragging down your entire portfolio's alpha for months.
Okay, so we're up against a massive wall here.
We really are.
Our biology shuts down our logical brain under stress. We're neurologically wired to avoid the pain of a realized loss. And our willpower just completely evaporates the second the screen flashes red.
Yep.
Are we just doomed?
Not entirely. The text offers a profound paradigm shift here. The core argument is that breaking rules is almost never a failure of willpower.
Really?
Yeah. It is a failure of structure.
Wow, that reframing is huge because we are so conditioned to beat ourselves up, you know. A trader takes a huge hit and thinks, man, if I was just mentally tougher, if I had more grit, I would have stuck to my plan.
But if we connect this to the bigger picture, willpower is a highly finite resource. It depletes rapidly under stress.
So grit isn't enough.
No. Discipline breaks down specifically when a trader leaves too many variables unresolved. Picture a live trade that is suddenly dropping, okay?
Okay.
If you haven't engineered the parameters beforehand, your hijacked brain is suddenly forced to answer a dozen questions all at once. Do I average down? Do I cut it here? Is this just a liquidity grab before a bounce? Should I widen my stop? That's exhausting.
It is. Every single unmade decision is a vulnerability.
It's an open door for the amygdala to just step in and say, let's just hold and hope.
Exactly. So the solution the text advocates is to remove decision-making from the stressful environment entirely.
Okay.
The goal is to make all critical choices about a position before you allocate a single dollar. You must define the exact entry point. You must define the precise invalidation level where you cut the loss.
Before you even buy it.
Before you buy. You must define the profit target where you scale out. And you must determine the exact position sizing based on your total capital. All of this is locked in when the prefrontal cortex is fully in control.
So what does this all mean? It means shifting the burden of discipline off of your exhausted mind and onto a mechanical process.
Precisely.
If you define the trade at the kitchen table, the only thing you have to do in the grocery store is push the cart down the aisle. You aren't deciding what to buy anymore. You are just executing the list. The author actually makes a bold declaration regarding this approach. They state, you don't need willpower. You've got to trust yourself, but systems will always win.
Because a system doesn't have an amygdala.
Exactly. A system doesn't feel the sting of a loss, and it doesn't get flooded with dopamine during a winning streak.
Practically speaking, though, what does trusting a system look like for someone, managing their own portfolio from home?
It looks like automation, and it looks like hard barriers. It means utilizing hard stop limit orders the very moment a trade is executed.
So the broker closes the position automatically if it hits your invalidation point.
Yes, you literally remove your own ability to hit the snooze button.
Oh, that's brilliant.
It also means utilizing bracket orders that automatically scale out of a position when it hits your profit targets, which prevents greed from keeping you in too long. And it means having a totally non-negotiable formula for position sizing, so that even if you feel completely invincible on a winning streak, the math dictates you literally cannot risk more than a set percentage of your account.
So it basically provides guardrails. Doesn't eliminate the volatility of the market, obviously.
No, nothing can do that.
But it builds a cage around your own worst impulses.
Exactly. Markets are inherently uncertain, and human judgment will always be required to interpret, macro shifts or fundamental changes in a company's valuation.
Sure.
The text isn't suggesting we turn over our entire financial lives to black box algorithms.
Right.
But by systematizing the mechanics of risk management, we dramatically reduce the number of micro decisions required in the heat of the moment. We preserve our mental capital for actual analysis rather than burning it all on just trying to suppress our emotions.
Okay, let's tie all of these threads together. Mastering trading psychology according to the discipline of profit isn't about reading more level 2 data or, grinding out another 100 hours of chart analysis.
Definitely not.
And it absolutely isn't about gritting your teeth and forcing yourself to be a more stoic, emotionless person.
No, it's about acknowledging your biological limitations.
Yeah, it's about recognizing that your cortisol levels will dictate your actions if you let them. It's identifying the triggers, right?
Right? The paralyzing unrealized losses, the boring sideways consolidation.
The FOMO-inducing spikes.
Yeah.
And the dangerous arrogance of a hot streak.
Exactly.
And above all, it's about shifting the burden, letting a predetermined automated system enforce the rules so your willpower doesn't have to.
Building a structural framework so resilient that your temporary emotional state simply cannot access the controls.
It is a profound way to look at how we operate under pressure. And that actually brings us to a final thought for you to chew on as we wrap up today.
Yeah.
We spent this entire deep dive looking at how our brains prioritize avoiding immediate emotional pain over achieving long-term strategic success, right?
Yeah, and how relying on sheer willpower in the markets is a guaranteed way to lose your capital.
But zoom out for a second. Think about how this applies far beyond your brokerage account.
Oh, absolutely.
Where else in your daily life, whether it's managing your career trajectory, sticking to a fitness regimen, or even navigating conflict in your personal relationships, where are you mistakenly relying on raw, exhaustible willpower to make the right choices in high-stress moments?
It's a great question.
Where are you hitting the snooze button when what you really need is to step back into a calm environment, take the emotion out of it, and just build a system? Think about it. Thanks for joining us on this deep dive, and we'll catch you next time.